Welcome, FinTech Talkers, to another edition of the FinTech Talk Show. I'm your host, Patty. My guests today are two of the greatest in FinTech. Tom Brown of NYCA Partners. Founded in 2014, NYCA is a venture capital firm focused solely on investing in financial services companies where technology is a critical competitive distinction. With more than 100 investments and 870 million in assets under management, NYCA is a big force in the financial services evolution. Tom is partner and general counsel of the firm, and in his prior life has spent 25 years as an attorney and angel investor in the fintech space. He's also a policy advisor at Paul Hastings and a member of the American Law Institute and the editorial board of the ABA's Antitrust Law Journal. Joining Tom is Luke Voiles, perhaps one of the greatest builders in small business fintech, with careers at Intuit, Square, and now Pipe, a unicorn many times over that he leads now. Pipe is eliminating the friction and bias of traditional financing, connecting business builders to quick, easy capital and helping them focus on their business. Besides streamlining capital access, Luke and the Pipe team have plans to be the single fintech for all SMBs and incorporate agentic AI. Yes, you heard that right, to take fintech to the next level. This is going to be a lot of fun, so stick around. Welcome, Tom and Luke, to the FinTech Talk Show.
Thank you, Patty. Great
Thanks,
to see
Patty.
you.
Thanks for having us.
Yeah, well, I'm looking forward to this. So before we dwell into fintech and AI and all the other things, anything you want to add to your experience and background that shapes your current thinking and philosophy?
I mean, I can go a little bit. I guess I have had two careers. One, I was a distressed credit investor, buying bad assets from banks for a decade. And so that definitely colors how I approach fintech. I'm always looking over my shoulder to make sure that there's no monster there chasing us effectively. And that you look forward and try to have a plan, kind of B, C, and D on everything. But the last 8 years of my career, I've been doing tech and trying to help really small businesses get access to capital.
Gotcha. No, that's very interesting. And distress, I hear a lot of folks who focus on that, not just in tech distress, but real estate and manufacturing and things. And they learn a lot of good lessons. So I'm sure that helps quite a bit. Thanks, Luke. Tom, anything you'd like to add?
Well, I started my career as an antitrust and consumer protection litigator. So not just a lawyer, but really a defense-oriented class action litigator. And the client that was my sort of gateway into financial services was Visa. And then went in-house at Visa in the mid-aughts and helped to catalyze the company's reorganization and ultimately public offering. And I think, we'll probably come back to some elements of why I think that transformation was important, but also that the background as an antitrust lawyer and somebody who thinks about market structure tends to inform how I approach investing and frankly advising companies, both on the law side and more generally on the strategy and product side.
That's fascinating. And I think we're kind of going through that in some other contexts, especially with Google and big tech and things like that. So yeah, if we can kind of weave that in, Tom, that would be fascinating.
I mean, Google's a really classic example. I mean, particularly with regard to Gen AI, right? So, one rough story about the evolution of Gen AI, right, is that Google did the path-breaking research through the teens and then became concerned about the possibility that Gen AI would undermine its position in search and web advertising. And so the mantle in the academic research was then picked up outside of Google, but the same sort of forces that were unleashed were now then captured by someone else. I mean, obviously a classic sort of innovator's dilemma problem, but I do think that sort of sensitivity to market dynamics is important and something I think that the best investors bring to the table, some of whom, have tended to be lawyers like Peter Thiel and Keith Rabois, right? Like,
That's right.
maybe not an accident.
That's right. No, that's very interesting. Meaning they do say history, if it doesn't repeat, it does definitely rhyme. And but this is probably, Tom, a show on its own, the antitrust and how that colors the investment. Maybe we'll touch on it, like you said, you'll touch on it. But it's a fascinating topic. Maybe needs an own show on it. We want to talk more about fintech and AI. So if I can start kind of on that. If we look at fintech history, perhaps, meaning I see PayPal and Adyen, but you can think about it as MasterCard's IPO or other things when fintech started as a segment or as a sector. And it happened around the turn of the century. I think PayPal was 1998 and around then. So almost like 25 years ago. There's been a lot of flavors of fintech, right? But primarily the innovation has been in the distribution of financial services, not so much on the product side, or there was not so much product innovation. But with things like embedded finance, I know, Luke, your pipe, and you are a big proponent there, and especially things like BNPL on the consumer side, digital assets, and there's some other innovations that are happening in fintech. Question to you both is kind of more philosophically, more broadly. Are we at the cusp of something big like product innovation and evolving the banking and finance primitives more than just distribution innovation that we can say has happened in the last 20, 30 years? And to add a little bit to that, how does AI and Gen AI and agentic architectures and all impact that evolution? So who wants to take that? It's a loaded question, it's a broad question, but I wanted to start like that.
I mean, I don't mind going first, I guess. It's like I guess my view of the fintech past is colored by where I worked, right? I was at Intuit for 5 years and then at Square after that. Intuit wrote the first version of Quicken in Pascal for the DOS operating system in 1984. Right. So if you go back all the way to there to see, okay, what happened at that point? Like people were literally sitting down at the kitchen table with a bunch of paper bills trying to figure out what was going on with their finances, right? That evolution for Intuit at least shifted when like Scott Cook used to literally follow people to their house and watch them install the software. And so when he sees people installing Quicken and using it to try to manage their business, he thinks, oh, you know what, we probably should build a business version of this and help them do their accounting. And that's where QuickBooks came from. But that's desktop install, like shrink wrapped floppy disk software. Intuit's done a good job of reinventing itself and moving to the cloud and then starting to add embedded financial services features, right? Like that one company actually has a lot of that history within it over time. But I think beyond Intuit's really a horizontal, right? Like they've been horizontally solving the problems of all small businesses to help them really just reconcile their bank transactions into an accounting ledger so the accountants can do stuff faster at the end of each month or quarter when they're filing taxes. And so where the newer shift is happening just on from horizontal to vertical, I guess. I think Toast was one of the best examples of taking on the restaurant vertical and just doing really, really well. You have things like I like the kind of esoteric spaces, but you like pest control businesses. That space is actually dominated by WorkWave. They have like 70% market share and 90% retention. It's a private company, but they report. It's private equity owned. And so back to the Toast theme real quick, you have now even more narrow with Slice for pizza shops, like that verticalization. And so if you just keep this trend going and you look at the AI tools, you brought up AI too, like here's an example for AI. My son is a sophomore in high school. He's been coding for a while, but he's now using Claude to create a SaaS vertical app, starting with appointments. We went to an art festival in Mill Valley over the weekend, and he's like, you know what? I could actually do an app that would make this work better for these sellers. It's like that sounds a little bit like Square to me, but I'm encouraging him to actually do it in a more vertical way. And he used Claude in his smart period, it's called, where they have time to do homework. And now he already has a prototype of that app. And he's 15 and he doesn't know anything about back end. Like he's just using these tools to have effectively like a team of programmers that can help him accelerate experimentation and MVPs. And so if you think about fintech is the thing that helps you automate the back office first from like a finance perspective. That's the whole like Intuit theme. Into Square, then adding the payment stuff, collecting payments, and then Intuit launches TurboTax and payroll and payments. All these things start coming together to help like effectively bring financial services to where the customers are spending their time. So like that's the whole other theme here is like where do the small businesses go to do stuff? They go into the vertical software now. If you're a nail salon owner, you will go into that vertical software of Boulevard, for example. They're a partner of Pipe to do everything you need to do to run your entire nail salon. And you can do it in that one software. You don't need Square anymore. You don't need Intuit anymore, except maybe to do the very last step of accounting. All of your problems are solved there. All the tasks you need to complete are there. And that's why like Pipe is now bringing all of the financial services, the banking services into the software to make it like available to them right there. So like that's some of the thing. I can talk about this forever. Let me pause and let Tom chat. But like this one I'm passionate about.
Yeah, no, before we get Tom into the conversation, so you make a good point around kind of the fintech more as a verticalized or vertical SaaS and solving the problem, right? And you touched on the Gen AI, the incredible your sophomore in high school is doing things like that. So how do you see that kind of intersecting? Is it going to fundamentally change SaaS, the software delivery model? Some of these agents and AI, or how do you see that evolving?
Yeah, and it's interesting. Alex Rampell wrote an article recently about the pricing models of SaaS versus the like task completion and charging based on tasks completed by agents. It'll be interesting to see where this evolves. But if you think about the value added by an AI agent, it could take the place of 5 or 10 employees. And so it's worth a ton to have an agent like that can go automate stuff for you. And so that should be more than $40 a month in SaaS fee. It should be thousands of dollars a month probably. But how you first show value to a business owner, for example, and then dial in what pricing actually makes sense based on what the thing is capable of. I guess it feels like there's a moat around true, like highly regulated, highly risky fintech stuff, like moving money and taking risk on lending, payroll, payments, all of that, like true, like banking-like stuff, because that's really, really hard to do. I would never allow an agent to go try to figure out all that stuff, right? You still need that grizzled credit veteran that's seen the crisis, like have the hands on the wheel, so to speak. But that stuff feels more protected than just SaaS. If you're a nail salon owner that's managing your inventory or booking appointments or handling calls quickly to do things, the agents will be able to have a massive impact there. And they could just like, every customer could just talk to the agent and say, hey, you know what, I wish you could do this for me too. And then the agent could just go build it and make it happen, right? All of those features and tasks and things will start to make verticalized SaaS even more vertical and enable tons of competition from sophomores in high school that can go out and build other SaaS tools that are similar for every micro niche you can imagine. But I still think the core banking like fintech stuff will have a moat around it in a sense
Gotcha.
because it's so hard.
Yeah, yeah. And I'm sure you have all these formed not just because you're learning from your son. You're probably doing something at Pipe too, which I want to get to. But let's get Tom into the conversation. So, Tom, around that original question around distribution versus product innovation, the factory of financial service fintech hasn't changed, but I know you're very kind of you close to some of the digital assets development and things like that. That besides embedded finance, BNPL. So what do you think about that broader question? Are we at the cusp of something big?
Well, I mean, I do think that there has been product innovation in financial services and specifically what we call fintech over the last decade. I think, I mean, I can think of a couple of things like off the top of my head that
Sure.
we now sort of take for granted, but that at the time they were being rolled out were fairly novel relative to expectations. One of them comes towards the end of what I think of as the fintech period, and that was Apple Pay. I mean, post-pandemic, the cash volume, check volume for for transactions between consumers and businesses is negligible in the United States, which have trailed the rest of the world in that regard. But if you sort of think back to when Jack and team were coming up with Square, right? Like cash was ubiquitous for small dollar transactions. Um, uh, um, and now with the way that people pay with phone and watch, like that, the opportunity to displace cash and check is gone, like that, and that is a major change in the behavior of consumers at the point of sale, and I think a real product innovation. And we can come back later as to why I think that sort of signaled the end of sort of one era in financial services, the beginning of the end of one era in financial services. Another, and this is sort of deeper into the weeds, but was sort of thinking about it as Luke was sort of discussing vertical SaaS and embedded payments. But I remember working with the team at actually both teams at both Square and Stripe that wanted to make immediate payouts to merchants possible in connection with daily credit card volumes, right? Because if you go back to, say, certainly 2006, 2008, even 2010, the chain of payments went so settlement institution, acquiring institution, merchant bank account. And each of those hops took 1 to 3 days, 1 to 3 days, 1 to 3 days. And folks at Square Stripe were like, well, why? Like, why does it have, is there some reason that it has to take that long? And the answer is no. You can do essentially $0 factoring so that as soon as the card is authorized, you can actually credit the merchant's account. Now, there may be some risk associated with doing that, but you can price that. Like that was a fairly revolutionary step, now kind of ubiquitous across the industry. Now, like extending that experience to other transactions turns out to be difficult. And I think tying this back to part of the preface of your question, which is like, are we at the cusp of something new? And again, I think one of the perils or benefits of being a lawyer is that, like, I tend to think of the core primitives coming sometimes from technology, like in that sort of speeding up the payment flow example. Sometimes it's law. Like, so there have been parallel developments both in Europe with electronic money tokens, part of NYCA, and in the United States, and Luke and other LPAs at NYCA, and frankly, much of the world has heard me talk about this until their ears have bled. But we now have a new chapter, a new article in the core plumbing of U.S. law, known as the Uniform Commercial Code, that recognizes what's called a controllable payment intangible, that you can sort of replicate the motion associated with a physical payment object like a check or cash with a digital object, and MiCA and electronic money tokens do the same thing, and that makes possible an experience that doesn't exist today. And tying this to pipe in funding a loan, because that problem that I outlined in how you get money from the bank that is the acquirer to the institution that happens to be banking the merchant happens every day when somebody wants to draw down a pipe loan or sort of factoring line. You have to say you want to get it, and then somebody's got to get the money to your account. With an ECM, you can now do that like literally instantaneously. It's basically just a ledger entry. You can do the same thing with a CPI. Like that's a big deal from my perspective.
Yeah. So the representation of money or the ledgering, right? The modernization of ledgering that kind of helps with that real-time settlement, that the problem you were kind of describing with the acquire bank and the T+2,
Yeah.
T+3 settlement.
Electronic payments in the US today, by and large, operate on an account to account basis, and there's a message associated with that account to account transfer that tells the people like what is going to happen. With a CPI or ECM now in Europe, the message is the medium of payment. Like, and that's a big deal.
Yeah.
Can
So
I like just real quick, like two things you said are super interesting. Like checks, like we talked to a partner last week, and one of the first BaaS type or banking type features they're doing is to build a mobile check deposit capture. Because many of their customers, when they send checks out to houses, still want to pay with check across most of America. Like checks still happen, like lots of them, and you still have to bring them in. Checks operate in a very similar way to the money movement you described a minute ago, which is effectively just ACH. Like the reason why it takes so much time to get the money to the customer when you like process a credit card at a coffee shop and then it goes to the merchant account, then it goes to the settlement account, then to the merchant account. When that last step, they send the ACH at the end of the day, and it goes out in the file the next day, and then the other bank on the other end sits on it for 3 days or 5 days even sometimes because they have to wait to see if they're going to get another signal that says, okay, it was actually returned. And so the money wasn't in the account, so I can't actually use that money because if they let that money go, it's their own money, right? And the money could get pulled back, and then they're out their own money. And so the payroll use case with ACH is similar. The payments use case sending it out. It's all because we have ACH, which was set up like as a not like literally like you can fax a notch file to somebody on a standard and make it work over time. It's kind of crazy that we still do that in the United States. Yes, we have same day ACH now, which is the same 2 or 3 day return problem. You can just process the file the same day instead of the next day, which that's not that great. Or you can do push to debit, which is a pretty big innovation to be able to push through the Visa or MasterCard rails the money quickly. And the thing about that is that you just know and have confirmation that the money is there. And then the risk of it going away is zero, right? Practically. RTP is the same. So RTP is the bank-owned competitor of that effectively. And so we have these, I don't know, the clearinghouse and the banks basically back a bunch of different money movement functions, but the Fed can't mandate that you use FedNow or even can't create all the features that ACH even has and do it instantly. Like that's the challenge with that stuff. But instant transfer is a big deal. Customers need their money now. They're willing to pay to get it, right?
yeah, yeah. RTPS and real-time payments. No, great
Yeah.
point, Luke. I think, Tom, I liked your point around the innovation sometimes driven by technology, but sometimes driven by the legal framework or the legal developments, right? And you kind of talked about the electronic money token development in Europe, and then there's some corresponding. I didn't catch that exactly in the
It's
US.
Article 12 of the UCC.
Okay.
It's the new digital asset chapter, and it creates a controllable payment intangible
Gotcha.
that effectively functions like a negotiable instrument. And
Okay.
so,
But if I were a small business, if I kind of use the problem that you first defined, right? When can they expect this to happen? When can they get real-time liquidity on their credit card receipts, for example? Are we close to that? Where is it in the journey, especially in the US?
yeah, so real-time payment on credit card receivables is now fairly ubiquitous. Uh, and as Luke said, you know, it tends to follow, it tends to be available if you're willing to pay for it. I think the innovation that we haven't yet seen in the US is, so again, so you're talking about checks. The volume of checks in the United States is like truly dumbfounding. It is more than 10 billion. By notational value, it is the third largest payment modality after ACH push and ACH pull. Like, it's truly astonishing. What we haven't yet seen, and they're largely confined to sort of B2B use cases, what we haven't seen is proliferation of this new sort of payment primitive CPI in push payment use cases replacing checks. I'm you know, we have a company in the NYCA portfolio called Fin3 that has built out a layer that supports that, and I'm optimistic that, you know, obviously that we'll see more of it. But having been, you know, very attuned to the space now for, and particularly this problem going back to when I first started working and talking with folks in the crypto community. So Chris Larson and Brian Armstrong back in like 2012, 2014.
Yeah, Ripple and Coinbase. Yeah, Ripple and
Yeah,
Coinbase. Yeah, go ahead.
and
Yeah.
Ripple. Yeah, Ripple and Coinbase. It's only like literally the last 2 weeks that I found somebody building a a a commercial lending application on top of a stablecoin asset. It's like that. So it just takes a long time. And that company is called Fence. It's in Europe. They're building it on top of electronic money tokens. And it's that door was opened because you know, the EU adopted a regulatory framework that recognized stable coins as a thing and defined the rights and obligations to the counterparties of transactions involving them. Like, so it just, you know, these things they just take a while before people sort of figure it out. And then once it's unlocked, then it tends to be ubiquitous and everybody forgets about it.
One of the challenges, though, is that the banks aren't incentivized to change because they make money when you move money through ACH or push to debit or on the RTP rails. If you do something else that's like a standardized open source style thing that's just perfectly accurate and everybody can see it all the time, they're not going to make as much money. And so they're not going to want to participate, which is a big challenge.
Yeah.
That
And
is true.
yeah, and the regulators are not incented either, right? To pass new things. Yeah. No, that I think you alluded to Christensen's the dilemma. I think it was you, Tom, earlier. I think it's a little bit of that playing out, right?
Yeah, the innovator's dilemma problem is real. Agency capture is real. You know, if you define prudential regulators based on the nature of the institutions within the scope of their regulatory ambit and give them an incentive to ensure that they're profitable, like they're, you know, they will tend to avoid doing things that undermine their profitability, and that's not the, you know, that doesn't completely capture the sort of regulatory impulse, but it certainly describes a good portion of it.
Yeah, and this is also a big topic, man. That one, just what you alluded. But to just kind of button up our kind of thread around product innovation versus distribution, what I heard obviously is the verticalization from Luke. That's kind of a big driver. And when we talk about pipe, maybe we'll talk a little bit more about that. The agentic AI and Gen AI and all those kind of fit into that in some ways too. And Tom, you kind of talked about Apple Pay and, of course, the settlement and digital assets. There has been some product innovation already in fintech, but I think we're going to see more of it going forward. So that's great. That's good segue to some of the other things we want to talk about. I want to switch gears and maybe talk about Luke and Pipe. I think a lot of people know Pipe, but I don't know if everyone knows Luke. So if you want to just give a little bit kind of introduction about what you're building and where you're going with it.
Yeah, I think the easiest way to think about it is from the underlying pain points of the small businesses, right? Like the number one pain point for small businesses is access to capital. So that's the first problem we're trying to solve. The number two is expense management and managing spend. So that's the second problem we're going to solve. We're going to add some of the other like nice to have features like auto savings for tax. When you're in the flow of money, you can easily save money to pay taxes at the end of every quarter or month if you have to pay monthly. We're going to add payroll. If you need to hire 3 employees, you can flip another switch to turn on payroll and start offering that to your customers as well. All of these main embedded financial services that every small business really needs, sending invoices, for example, we'll add those capabilities to allow small businesses to succeed. It's interesting, like Intuit, Square, PayPal, Toast, a lot of these other larger platforms are doing these things for their customers, but they're only doing them for their own customers, right? the big shift here for Pipe is that we're partnering with other like small and some very large platforms that don't have these financial services yet, but they can partner with Pipe to offer capital to their customers, for example. So Boulevard Capital powered by Pipe is a great example. It's a trusted brand. The customers come in, they see they're doing managing their appointments and they're taking payments, and then all of a sudden they see a pre-approved offer for capital. It could be a women-owned business, immigrant, no FICO score, and has a nail salon with 10 seats that are filled with 10 to 15 appointments every single day, and just does 500,000 plus in revenue every year in a very consistent way, in a kind of recession resistant, recession proof kind of way. And we're able to put a pre-approved offer for $50,000 to $80,000 in front of that business owner who would never think to even go to a bank to try to ask for a loan because they don't have a FICO score. Yes, they have a social and an SSN and they're in the system, but they don't have any history to have access to the financial system. And so for us to be able to bring modern embedded technology and financial services into these vertical like software startups that are able to like help these small businesses succeed, that's the core piece of what Pipe is doing. It's helping solve those underlying pain points and partnering with all the verticals that are popping up to help solve these problems. There's no way, like Square is struggling to compete with Toast because they can't bring, like, if Toast is bringing all of their resources to bear to solve the restaurant's problems, there's no way Square is going to be able to compete with that across 15 different verticals, right?
Yes.
It's just the future is these like narrowly focused vertical opportunities, and Pipe's going to be there to help them all launch all of the financial services, make it fast, and help millions of small business customers.
Yeah, and I can see why you're bullish on the verticalization, because you are embedding, pun
Yeah.
intended, into the workflow, into those software, into those vertical SaaS. Where's the balance sheet coming from, though?
Two ways. One, we have 400 million in capital from debt providers that lets us do $1.2 billion per year. But in order to truly scale a business like this, you have to be able to go balance sheet light. And that's one of the things that Hans told me when I talked to the NYCA folks about maybe taking this role and leaving Square. That his advice was, if you can get to balance sheet light, this thing could really go. But if you can't, you'll kind of stall out. You'll need to have equity for every single loan you're making, and you'll eat up your equity in growing the business. And that doesn't work. And so the part of the reason why we chose the Square Capital-like product, or PayPal Working Capital, or Stripe Capital-like product, is that the capital markets knows that one really, really well. We originated at Square 5 billion in volume the 12 months before I left, and kept 25% on balance sheet and sold 75% of it. Right. And when you can sell it and book a 6-point gain on sale every time you sell them, so originate in the morning and then book 6 points of revenue with no risk and then move on, you can effectively do an unlimited capacity in this. And so getting to a balance sheet light setup where you're really just more of a platform that can originate the risk and then immediately sell it to the capital markets, that's the spot we'll get to. You always want to keep balance sheet though, just in case, right? There are lessons from 2013 with the consumer lenders and Prosper in particular, where their whole loan sales dried up and they didn't have a warehouse, and they ended up having to give up something like 35% of the equity to a group of lenders to actually get a deal done and move forward. And so you need balance sheet just to protect yourself through cycle, but you need whole loan sale to be able to scale in an unlimited way. And like the joke of these businesses is that you have to be able to navigate every cycle. And if you don't, you won't survive. And you see it like I'm seeing a lot right now. There's a lot of startups that we're trying to do capital-like products that raise money in 2020 and 2021, and they're falling to the wayside because they can't figure it out. They can't get it. It's just really, really hard to do this. And Pipe has been executing flawlessly. So that's it. It's like my background is capital markets, and that's why it's pretty good fit for Pipe, I guess, to have me here.
And you're kind of almost inventing, and I think you use this in your marketing, embedded capital, right? So that's what you're doing.
Pipe capital as a service, right? You should be able to offer capital to your customers without taking any very little regulatory, no like monetary risk, very light from an engineering perspective. We'll do it for you, and you can white label it and brand it as your own, right?
Yeah. So Tom, I know NYCA has embedded finance in their portfolio companies. Do you see similar kind of thinking in those companies as well? Do you want to take some examples or?
Sure. I mean, trying to think through the examples that are sort of truly embedded either on the consumer or the SMB side. So Bridget it would be an example. Funbox. Man, I did a lot of work with these businesses back in my private practice capacity. Square, PayPal,
Buy
Paraffin,
now, buy now, pay later is a good example
all
too.
the BNPLs, right? Uh, and yeah, I mean, I have seen the story that Luke outlined, right? Like you have to get to the point as that provider that you're not funding every loan either with equity or with your own sort of warehouse and borrowing capacity. You have to get to the point where you can push that product off to the capital markets. Uh, and like honestly, one of the great decisions that was ever made in the Paul Hastings fintech practice. My friend and also a NYCA LP, Chris Daniel, was adding Rich Davis to our team because Rich was and is like the preeminent lawyer for helping people sort of think about and obtain capital to support an embedded lending business. So yeah, it's an absolute, I mean, that it is the way, like that you cannot get to the place where Luke and Pipe are without that, and let alone get to what they imagine is the sort of end destination.
And what about the verticalization emphasis that Luke brings in his thing, right? So it makes
Yeah.
logical sense that embedded, when you want to embed in existing workflows. They are not horizontal, they are vertical, right? So that's very logical. But what do you think about that? Is there horizontal opportunities as well or is it fintech's going to largely verticalize with embedded?
I mean, it's the sort of classic bundling and unbundling problem. Like, Square sort of started as a vertical solution aimed at a specific category of merchants, largely cash, either mobile, right, in the case of sort of food trucks, or those that were unlikely to be underwritten, coffee shops and other sort of small scale service businesses. But then sort of product innovation, Square Terminal, then the product can cover a broader set of verticals. And then as you face sort of competition in specific verticals, then things sort of narrow again. That's just sort of like, it's like the tides, like they, as Luke knows, I am a member of the Dolphin Club and swim. I will say I was so glad to do this, but it did interfere with my effort to swim today. So, but one of the things in the bay, and one of the things that you learn pretty early as a open water swimmer in San Francisco is, what is the tide doing? Is the water coming in? Is the water going out? Because you kind of want to know just mentally how hard that last stretch to get back to shore is going to be, particularly in the winter when it's cold. And so, like, I mean, I actually have a question. I am curious, Luke, from your perspective, like, how much variability do you see in sort of performance by vertical? I would imagine that the underwriting criteria are different, but I'm curious.
Let me kind of frame how we do it first and then
Mhm.
describe why it actually doesn't matter that much. So if you imagine a coffee shop that sells 1,000 coffees a day, that is the most consistent payments history you can find, right? They're just constantly selling stuff all day long out of that one terminal. You can look at 6 months or even 3 months of history of that and predict very accurately with not even that sophisticated of machine learning, just like XGBoost, and try to figure out what the next 12 months is going to look like. And because you're advancing or lending against that single cash flow stream and then getting paid back first in line on the same cash flow stream, you can ignore the expenses. right? And so when you're doing that and you think about all these different industries, what it comes down to really is just how regular are they, how like, and what, like how often are they taking credit card transactions or getting paid by ACH? And so anything that is like a physical retail or e-commerce is great. Anything that's service-based businesses where they're sending plumbers and electricians out works great. It starts to fall apart at the other end of the spectrum. Like restaurants are perfect. Like it starts to fall apart at the other end of the spectrum, which is like construction, where they do a bunch of work, there's performance risk, they send an invoice and they get paid monthly. That is not regular enough to predict. And there's real cyclical things that happen in trucking and construction that make it really hard to actually lend into those spaces. It's very idiosyncratic. Anything asset backed is out because it's just different from a legal perspective. And so it really comes down to, okay, like, is this business are they like processing at least 5 credit cards a day? And if they are, the model works great for it. And so I think the risk different comes in whether it's a direct customer coming to Pipe to say, hey, you know what, I want a loan. And we're like, okay, like what are you using? Are you using Square or Stripe or something else? Like how long have you been a customer? You never really know. And so you like that risk is way higher. If they've been using Boulevard for 6 months or 12 months, or when I was at Intuit or at Square, like these examples are easy. Like at Intuit, we didn't offer a loan unless you've been using QuickBooks and reconciling transactions from a bank account for at least 6 months. That meant fraud was zero at Intuit. We've had zero fraud at Pipe because we partner with these vertical businesses and have track records of real businesses doing real stuff. And so that actually embedding into these verticals where these businesses are doing stuff, that also dramatically reduces the risk because the retention is so high, they're not going to go somewhere else. They can't, right? They're running their entire business. They're trying to grow their business, right?
I have a question sort of on the same topic, and the source of it relates to trying to understand some of the fundamental shifts since the pandemic, right? So, obviously productivity across the US economy is improved. If you go take a tour in DC and you talk to folks at the Fed about this, and you ask like why, and like you'll literally get the shrug emoji, like don't know, not sure if it's real. But in sort of thinking about your business and the verticalization point that you made earlier, and what I'll call the sort of SaaSification of Main Street, like coming into the pandemic, right? We had this vast ecosystem of small business across the United States.
Mm-hmm.
Then we had the sort of mass extinction event that you then have those that survived are probably better than the base, than the median or at least the lower ends of the distribution. And those that have now sprung up are taking advantage of tools like vertical SaaS and just operating
more efficiently
and more sophisticated. And so like we shouldn't be surprised in that sense that the economy is as productive as it is, even if like it is up like a full point, which would be a 50% increase over the prior 2 decades. I'm curious, what are you seeing like in your exposure to sort of vertical SaaS? Like
it's next time you book an appointment to get your like hair trimmed or shaved.
Come on, no hair jokes.
Okay. Next time you do that, like think about what the experience is like. Like I log into an app and book an appointment quickly and it automatically takes my payment. It's like an Uber-like experience. Every single hair salon can do that now because they have the software. I think if you roll back even 10 years, private equity had this massive advantage and they would go roll up these companies and invest millions of dollars in IT resources to try to automate all that stuff and create good experiences and then roll up these other businesses to make that happen. Like my brother wants to go buy an HVAC company and like use House Call Pro or something to go run it and then try to roll up more of them, right? It enables you to go be like a big private equity company and have operating partners in your pocket because you can just do all this stuff. So like that analogy, I think
I do think it's actually like one of the secret weapons of the American economy and doesn't get enough attention. I mean, it's like you took all of the genius associated with the franchise model.
Yep.
But without
That's a good analogy too.
All of the weirdness associated with single brand and the sort of principal agent problems, And like now you can just access it through the internet, like, and it's amazing.
Right. If you're a chef and you know how to cook really good food, all you need to do is go sign up with a Toast or somebody or
Right.
Spot On to go like launch a restaurant in so much of an easier way. You don't need like a very experienced restaurant manager that you have to pay half your profit to. You can just go do. It's pretty powerful.
Yeah. So maybe that's a good segue to talk about AI, right? So you have chefs, you have kind of Main Street businesses, knowledge workers, as I broadly call them, like not just chefs, but kind of IT workers, programmers, and things like that. Now you have
Lawyers,
AI
accountants, dentists.
accountants, tax preparers, exactly. Yeah, all sorts of folks. So now AI is able to do, if not everything, but some of those work, and they're hyper specialized, and they can be trained to do things, even go up the food chain to kind of medical advice and that kind of stuff. Um, so how do you see that evolving? And we can talk kind of broadly or kind of target kind of more financial services and maybe CFO and financial functions, say for the small business. Luke, you want to take that first?
Yeah, sure. I was lucky enough to find an amazing CTO right after I got to Pipe. And so her name is Namrata Ganatra. She actually was a founder that had an AI e-commerce startup using ChatGPT 2 before anybody was ever even talking about this. And so she built that company and sold it to Thrasio. Thrasio story is a different one and ends poorly. But she's already done it. She built an AI e-commerce kind of agent to help Amazon sellers like figure out what to do and how to run their businesses, right? So we have a deep experience in building stuff in this space, and we've already got a proof of concept that's about to be productionalized. We're calling it the AI CFO. That is supposed to be just the sidekick where you can just talk to your phone and have it tell you about how you did last week. It may tell you that you need to go order more flour if you're a donut shop, like that type of stuff, just to understand what's going on and like visualize data for you. So that's just the kind of knowledge agent, right? That same stack can be applied to doing tasks, right? And so one of the ideas is to like automate all of the tasks that the small businesses are completing in these verticalized software. So the interface becomes the AI agent from Pipe to where you talk to it and go do everything. Go pay payroll for me. Well, oh, sorry, you don't have enough money. Would you like to draw your line to automatically pay and go pay payroll? You're almost out of shampoo. Should we order some for you? And it starts to actually go do those things. That's a pretty cool piece for the underlying customers. But then you take a step back and think, you know what? Like we're very like operationally automated at Pipe. And so you look at like Amazon is famous for saying, hey, just do stuff manually until it's too big or takes too many people. Then you can go send product engineering after it to try to automate. I still think you should try to do that first, right? When the sales team becomes super efficient when you start to automate tasks for the sales team, the underwriting team gets data pulled in through Alloy from 50 different sources, puts it up in a UI so the human can actually make a decision. You make that extremely efficient. You try to optimize the rules to like get more true automation and have people not come through. But once you've done all that operational automation, then you can take that AI stack we built and say, you know what, like let's have it talk to the customers on the customer success side and see if it can solve these problems. And then only have a tier 2 level. And so you need way less humans to scale a business. Same thing on the sales side. Could this agent actually be the sales like chatbot to talk people through? Like, yes, it really is that easy. You can click right here and take the advance because it really is only 3 clicks. Like we don't need to pull your FICO. There's no personal guarantee. It's okay, go ahead. Like sometimes customers just need that hand holding, right? And so when you build a stack that can be applied to our internal business problems and operational problems, and also our underlying small business customers' operational problems through the software they use, like that's where all of this gets super exciting. The thing that's most interesting though is that anybody can go get this stuff from Amazon or from Google or from Microsoft on Azure with OpenAI and like build a stack if you have the right technology and apply it to your business processes internally. I think Salesforce just went all in on this at Dreamforce, the agents, because they know all of this like drop down stuff to select and automate business processes is about to be automated away and nobody's going to use Salesforce anymore. They're going to use these agents. And so they're trying to trying to rapidly innovate into that world themselves. Like this is all happening so fast that it just blows my mind. And to get to apply it, to get to build a brand new business like Pipe, apply it internally and also apply it outside. It's really cool to get to try to like play with all this stuff. And then to see my son able to do it with Claude and code, like it just blows your mind when you realize how powerful this stuff is. It's pretty crazy.
Yeah, no. So it extends, like you say, it's not only CFO, like it's great Pipes building a small business CFO agent. So a small business may not even have to kind of process reports. A lot of the AI will do a lot of stuff for them or do a lot of decision making, but it can be extended, like you said, to taxes or other functions. So Tom, are you seeing this kind of trend as well? Kind of more the agentic trend in some of the deal flow that's coming in?
Um, I mean, I guess yes. It sort of. I mean, I think one of the challenges though is, and Luke said something. I mean, he said this earlier. If you're thinking about areas of business and business operations that are likely to be more resistant or inoculated against this trend, it is highly regulated industries and highly regulated workflows, right? So, and financial services is in the sort of perpetual contest with pharmaceuticals for the most regulated industry. Uh, and so, like creating real agents or like self-driving bits of code to engage in transactions for businesses and consumers, just faces some in some developed defenses.
Sure.
I mean, the SEC, for example, has restrictions on the degree to which people can engage in robo trading, and there are sort of circuit breakers and pretty significant consequences if you create an algorithm and something disrupts the financial markets. Uh, and there are some sort of similar sort of regulatory barriers if you're trying to deploy something for consumers. So I think there are ways to incorporate aspects of that technology, humans in the loop, and more advisory, non-financial, but like that's not where you're going to see it in the first instance. I think the place where in areas of investment interest that might not be specifically NYCA related, but more sort of personal, is the collision between law and tech.
Mm-hmm.
And there is a lot more room for that sort of eugenic type workflow. Again, it will often have humans in the loop, right? So it's going to be a long time where people are getting advice from a programmed agent, but you can create a programmed agent at the beginning of a workflow to sort of collect the information and qualify people before introducing them to a lawyer, and that's a pretty powerful addition to the sort of legal toolkit. I mean, because one of the biggest challenges as a lawyer, if your responsibility, so partner at a law firm, or if you're sort of a solo practitioner, is like, how do you allocate your time between talking to people who might become clients, serving existing clients? And you have to develop the ability you have to develop a pretty good batting average with people that you're going to meet, so that you qualify them as a client and you get money out of them, right? Like you can't just have a bunch of free consultations. That is the road to perdition.
Yeah, yeah. Now I see what you're saying, and kind of more the co-pilot versus fully autonomous agents, right? Maybe we have a phase where we have a lot of co-pilots for every worker, every persona.
Yeah, I mean, I think more like what Luke described his son doing, right? Which is you can access all of these tools and you know, with some degree of sophistication, you know, perform at levels that would have been achievable only by people in the top 1% of the profession. Like, you know, augmentation has pretty interesting distribution effects. So
Yeah. Luke, you were trying to get something in?
I mean, no, like just using like specific examples in legal, like I think narrowing to just solve the high volume problems, like discovery, for example, to have an AI agent that can help process reams of information faster. Or on the, I think on the, I was a hedge fund equity analyst and then a credit guy and spent inordinate amount of time in my career going through 10Ks and 10Qs and extracting financial information, trying to normalize it, trying to like adjust for transactions and all kinds of stuff, and just try to figure out what the heck the monthly like revenue and expenses look like over a multi-year period. The agents like can do that really fast now, and like you don't have to just getting the data into Excel was a pain in the ass like 10
Yeah.
years ago or 15 years ago. But like there's so many like little things that help people become way more efficient, right?
right. That synthesis and extraction
Yeah.
is a huge, just a giant leap forward. And you know, I've invested in at least one company in that space. File read that, you know, you basically take a discovery record, drop it into a container, interrogate it with AI. It's multiplayer, so that an entire team can look at it. And it will sort of spit out the core things that you need to think about how to litigate a case, right? Like, so who are your best witnesses, you know, who are your best documents, worst documents, rough chronology. Like being able to do that in minutes, without a human, like as a first draft, is pretty amazing.
Yeah.
Uh,
Yeah.
uh,
Yeah. No, and so we kind of switching gears a little bit, Tom. We did touch on some of NYCA's portfolio company examples, but we didn't kind of step back and look at how the investment thesis in NYCA's thesis. I mean, you're almost approaching $1 billion in assets under management. I think 100 plus investments. I have a lot of startup listeners for the show, early stage, kind of Series A, that kind of stage too. So, do you want to describe what you look for in startups that come to NYCA, or that you like to invest in, investment thesis, or broadly
sure.
NYCA's? Yeah, go ahead.
I mean, we are famously thesis driven, and have I would describe it as a fairly traditional definition of financial services. So payments, deposit services, liquidity, so both lending and factoring, advisory, insurance, capital markets, and infrastructure. Unlike some fintech focused funds, we tend not to include marketplaces. And if you look across our portfolio, you know, we have historically been pretty heavily weighted towards tools that are going to help incumbent financial institutions. So I describe us as the sort of incrementalists of the financial services tech revolution. There are the, you know, the fringy revolutionaries. We are not them. You know, so companies in our portfolio like Thought Machine, right? So a modern core, companies like Ethic, making it possible for people to sort of construct portfolios that are more aligned with whatever you know, particular set of values they might have. Like those are very sort of core NYCA type investments. I mentioned, or at least alluded to Fin3 earlier, which is sort of building on top of that like very obscure Article 12 payment primitive CPI. Like there's a reason why, you know, we're on that cap table. And then, you know, I think particularly in fund four, sort of also trying to pay attention to like the technology fringe. So, we've been spending a lot of time with modern cryptography companies, right? So how do you bring and make accessible multiplayer cryptography within a traditional organization? If you imagine, right, that there's going to be a more native digital payments future, you need to think about how you accommodate basic business processes and those kinds of digital assets. So that's a place where we've been spending time. Deeper tech, like quantum. These are all areas of interest.
Cool. Very cool. And what stage do you typically get in?
So we're seed and A primarily, but technically stage agnostic. And so we'll do both pre-seed and growth.
Okay.
So, one of the notable investments out of our third portfolio was Revolut. And we did that at a growth stage. And very happy that we did.
Okay. So it's both US and European companies, maybe outside Europe as well, or
Yeah,
not?
outside of Europe, we've invested in companies in Southeast Asia, Singapore, so Capita, Korea, Chai, a number of investments in Israel and Europe. So we've done a little bit emerging market. So Africa, another notable company in fund three. So we're now investing out of fund four, but still have reserves from fund three is Nala, right? Which is a US company, but that is serving the African diaspora, both in the United States and Europe, and building out a pretty interesting payment business across the African continent.
Interesting. Yeah, I have a lot of listeners. I was rated, or FinTech Talk was rated like top show in Southeast Asia, Middle East, and a couple of countries there.
Okay. Well, come on down.
Yeah. So before we close, I know we're kind of just a little over an hour. The U.S. presidential election's just less than 50 days away. Any thoughts on more policy aspects between the two candidates, two parties, especially in the context of fintech, small business, and if you like to demur, abstain, I'm fine. But
No, I mean, it's as somebody who's been involved in politics and policy from like probably before my legal career, but certainly throughout it, like it's an important thing that every business, particularly every business with exposure to the US, needs to have in mind. I think before speaking to where some of the differences might be between the two candidates, I think useful to think in mind what the distribution of outcomes is likely to be, because a divided government outcome, right, is a very different outcome than single party control of both houses and the White House. And I think right now the sort of consensus estimate is that 75% of the outcomes are going to involve divided government in some form or another. And if that's the case, like the relative shifts from a policy perspective in any domain, but in financial services, likely to be small, just because you won't be able to get the votes necessary to create real change. If you see sort of a unified government, either on the Republican side or the Democratic side, like that, prepare for some, more volatility. So within that frame, obviously the two candidates, Vice President Harris, President Trump, very different in terms of how they present personally and what they identify as their core values with respect to financial services. And I think, but there are some areas where the degree of difference between the two of them is probably a little bit smaller than either of them and the current president, and not necessarily because there's that much daylight, say, between Vice President Harris and President Biden, but the political climate and culture is a little different. And so I'd say digital assets in particular,
Mhm.
this Congress attempted to reverse a rule from the SEC related to whether regulated financial institutions could hold digital assets on their balance sheets. That failed, but a large number of Democrats voted in favor. There was a bipartisan consensus to reverse that rule. And I think Vice President Harris, with respect to some of the things that she said about crypto, has sort of taken that signal and is signaling accommodation with respect to digital assets. I think obviously President Trump, who has, I think, announced today a crypto business of some kind, right?
Really?
Um,
Oh, I didn't see. Okay.
yeah,
Mhm.
hugging that community even more vigorously, but that's an area where I would expect less difference. Uh, um, I think in terms of fintech, right? So if you look at the issues that are currently roiling the community, uh, you have a number of rules from the FDIC. So the broker deposit rule, for example, the new guidance related to third-party risk management. I'm not sure the broker deposit rule survives in any future state just because of some of the changes in administrative law. Um, I think it's less likely to survive in a Trump administration than a Harris administration. That would be an area of difference.
Chevron, you're referring to the Chevron.
Right. So Loper Bright reversed Chevron
Right.
and will make it more difficult for agencies to sustain their rules going forward than in the relatively recent past.
Yeah.
But an area where I don't expect there to be a ton of difference, and this might be somewhat surprising, I don't know, but say 1033, right? So we now have a proposed rule. The agency is in the process of finalizing it. We expect that rule sometime before the end of the year. Director Chopra has signaled by the end of October. Having been through this process before, sometimes October has 45 days as opposed to 31. This might be one of those Octobers. I don't know. But that process actually began under Rich Cordray with a set of principles that were issued in like 2014, and then Kathy Kraninger actually formally kicked off the rulemaking process. Like I don't expect there to be a dramatic change with respect to the outcome, at least from a rulemaking. Now, again, I do currently anticipate there being some litigation there, but the uh, relative to other elections, I would say that with respect to policy, particularly on the financial services side, there's more nuance to areas of anticipated difference than others. And the other thing that people have to keep in mind, and Luke knows this quite well from his various journeys through financial services, every reaction at the federal level creates an almost equal and opposite reaction at the state level. And so you have to pay very, very close attention to how the states react to whatever the federal government does or doesn't do.
Yeah. Oh, that's great.
That's the
Luke?
Tom Brown law of political thermodynamics, I guess.
Absolutely.
Entropy, I like it. Luke, anything on the presidential you want to add?
Yeah, I mean, we're a member of the FTA, the Financial Technology Association. There's a bunch of large fintechs that are part of that, and through that we engage directly with the regulators, right? So Federal Reserve, FDIC, Treasury, NEC, OCC sometimes as well. And so for us, the good thing is we're very pro small business, and I think both administrations are also very pro small business. That is the engine that drives this economy. So either way this election goes, we will continue to engage directly with those regulators. And yes, the person at the top may shift over time, but ultimately those agendas don't shift that dramatically. Like the Hamilton set this thing up the right way, where we kind of get pulled back to the middle, and crazy stuff may happen in one administration or another. And divided government actually is a good thing and can actually keep us from doing stuff that is too drastic and too different. So we will just continue to engage with the regulators and try to advocate for small business. And I think like a couple of things that matter the most, like BaaS, like banking as a service matters. We're able to offer these amazing features by partnering with banks. That won't go away. There's stuff coming out now saying, hey, the bank, you really just need to reconcile the transactions too. It's like, of course, like any of the good banks are already doing that. It's not going to change anything, right? Because a couple bad guys or bad folks found each other and did stupid stuff, it makes all of us look bad. And so you have to go tell Greenberg that at the FDIC and say, look, like we're doing this stuff the right way. If the banks just follow their third-party risk management, everything would be okay. And we did that. And he said, yeah, I agree. Let's just enforce this stuff. And it's like, okay, great. Let's move on. But that's our hope, is like you get reactions like that. These things if you go back to the global financial like crisis and think about how big these problems were, what we're going through now are very tiny events that are like hardly hitting the radar of the senior folks at some of these regulatory organizations, because they're just not that big a deal as long as you just start enforcing stuff the right way. So for us, it's just engage and influence and show them how fintech can be good for businesses and good for consumers. And the more we can tell that story with real customer stories, the easier it is for us to get like support from the regulators, right?
Gotcha. Yeah. Now, and Luke was alluding to the Synapse debacle, and I think Tom was talking about 1033, the PSD2 of the US in some sense.
Thank you for translating for us.
Yes.
That the CFPB is in the rulemaking process. For those who are not familiar, I think a lot of people know all the terms and acronyms. But thank you. I think this is fantastic. In closing, I'd like to ask you, what are some of your next milestones? Who are you looking to connect? My audience is spread out: startups, bankers, digital innovators, and that kind of stuff. And where should the audience look to follow you with social media, and if you want to give out that kind of stuff? And if I may ask, any predictions on next big thing in fintech and AI as part of your closing? Who wants to go first?
Well, I'll certainly start on the social media side, and then, maybe I'll come up with something on the big prediction. So you'll find me as TP Brown 5 on virtually all the socials. So X, my LinkedIn profile, that is the actual sort of you in the URL, but you'll see me as Tom Brown. Insta, even Strava, I think that's my handle.
So we can see your swims in the bay.
Yeah, sometimes more of the bike rides actually, but
Okay.
because Apple doesn't really like to connect to Strava anime. I don't know, it's confusing sometimes.
It works fine for me. We should go on a ride sometime.
Sounds good. In terms of, hot takes with respect to Gen AI, just sort of elaborating on what I said before, I think the applications that will be developed and deployed in the near term, you will see their impact more outside of financial services than in industries where generation and synthesis of unstructured content is more sort of directly relevant. So there's some companies in that space that I'm very, very fond of, and I think are using AI in creative ways, like Rico.ai. Companies in our portfolio like Fairplay. I think this next period in financial services innovation is going to be defined by people taking advantage of sort of new product opportunities. We talked about electronic money tokens and controllable payment intangibles, and then applying them in places where the efficiencies associated with using those tools are enormous. So not unlike what Jack and team did with Square 15 years ago. I remember sitting down with Keith Raboy at the Grove on 3rd and Mission, and he had just started, and he sort of pushed this little piece of plastic across the table, and I was like literally, what is that? And he's like, it's a card reader. It's like, oh my God, like that is awesome. It was magic, right? Like, finding the pockets where you can create something truly magical, like, harder now, because the entire ecosystem is so much more sophisticated. But when you see it, like, it's real. So I'm very optimistic about what the future will bring, and it's never too early to talk to me. So
Yeah. No,
just
that's a piece of fintech history, with Keith and pulling out the Square off Square in where was the location again? At the
the Grove
Grove. Yeah.
at Third and Mission.
Third mission. Wow, that's some fintech history. Thanks for sharing with us. Luke, closing.
Yeah, so the easiest way to get in touch with me is on LinkedIn. You just search for Luke Voiles and Pipe. And then for Pipe, go to pipe.com, and we have a great website you can check out and see what's going on with us. For like future predictions, my sincere hope is that it just continues to get easier for consumers and small businesses to manage their like lives or their financial lives or their businesses, and all the fintech stuff is just making it easier and easier. Just like Square allowed the like farmers market seller to accept a credit card, and now you can, everything that happens after that and managing the inventory, all this stuff starts to get added, and it's, they don't have to think about any of the like operational business, anything like my C-suite does for Pipe will be automated for a lot of these micro merchant businesses. And then one example I think is a good one because it's been solved more recently, but if you've ever used Concur to do your expenses versus using Ramp, like that is a night and day difference between getting a text after you swipe a transaction and say, hey, send me a picture of that. And then you're done because it automatically reconciles it versus I don't even know what the UI of Concur is. It just takes, I could never even do it. It's so hard to figure out. And so like even like simple things like that's an enterprise product though, right? One of the things Pipe is working on now is we just launched a card offering, and we're going to bring the Ramp or Brex-like experience to the micro merchants for the first time because that risk is so hard. So there's still pockets of businesses that don't have those features yet. If you're a micro business that doesn't have a FICO score, it's just too small. Capital One can't help you. Amex can't help you if you're less than 640 FICO. Brex and Ramp are both way up market, right? And so I think there's a real opportunity for us to bring those amazing like product-led features to the micro merchants on that side too, and just make that one part easier, right? Like that's the whole joke. And the AI tools are going to make it happen faster. Like as like the Age of Accelerations is a great book. Like we're at an age now, there should be another couple of chapters about how much faster it's going to accelerate because of all the agentic tools we have access to, right? Pretty cool stuff. I'm happy to be like living through this and building through this. It's pretty cool.
No, that's great. Thanks. That's great. Thank you, Tom and Luke, for being on the FinTech Talk Show.
Awesome. Thank you.
Thank you, Patty.